I think, yeah, thank you.
Right. Okay. So welcome everybody. It's great to have you in this new iteration of the Corporate Governance Knowledge Labs. And it's a great honor for us to have Tracy Wang from the Australian National University. Tracy has a fantastic record of very important pieces of work, empirical and theoretical work on corporate governance. So we are very pleased to have you today. And she's going to be talking to us about something that is super topical, right? So biodiversity risk and how that affects market price earnings. And I think it's very preliminary work. So she has actually asked that nobody cites her work without prior communication with the authors. And I hope that everybody can respect that. But as it happens with all preliminary work, of course, I'm sure, Tracy, you're going to be more than happy to get comments after your presentation, and we can have a lively discussion. So the virtual floor is yours. We are all looking forward to this presentation. Thank you so much.
Thank you very much for the kind of introduction. It's a pleasure to be here. I would like to thank Associate Professor Tracy Wang for the invitation and the BAFA Corporate Governance Knowledge Lab for hosting this event. In today's seminar, I will present a paper that examines whether firms' exposure to biodiversity-sensitive areas affects how investors react to earnings announcements in capital markets. This is a joint work with Amir and Lilian, who are finance scholars based in Canada, and Nathan, who was my previous PhD student and is now an assistant professor at Zhejiang University. This is still work in progress, so I very much welcome your comments and suggestions. Let me start by explaining the broader motivation for this study. Over the past few years, biodiversity loss has increasingly been recognized as a material financial risk rather than just an environmental issue. For example, the Gascupta review commissioned by the UK Treasury emphasizes that economic activity fundamentally depends on nature and that biodiversity loss poses significant financial and macroeconomic risks. Similarly, the Network for Greening the Financial System, which is a coalition of financial regulators and central banks, warns that biodiversity loss could threaten economic resilience and financial stability. Because of these concerns, we are seeing strong policy momentum globally. For example, the Kunming-Montague Global Biodiversity Framework introduces the 30 by 30 target, aiming to protect 30% of land and oceans by 2030. In financial reporting, the Task Force on Nature-Related Financial Disclosures, or TNFD, has been established to guide firms in identifying and reporting nature-related risks. In Europe, biodiversity disclosures are being incorporated into corporate reporting through ESRS E4. So at the same time, investors are increasingly paying attention to biodiversity risk. Many institutional investors now asking firms to disclose biodiversity-related information, and large asset managers also increase pressure on firms. Despite this growing attention, we still know little about how biodiversity exposure affects the way investors process firm information. This motivates our study. We ask whether corporate biodiversity exposure affects the market's responsiveness to earnings news. Empirically, we examine whether firms with higher biodiversity exposure exhibit weaker stock price reactions to earnings surprises. In other words, we test whether biodiversity exposure reduces earnings response coefficient, or ERC. In additional analysis, we also test the other measures of market reaction. To understand biodiversity exposure, let me briefly explain protected areas. which are the key institutional context in our setting. Protected areas are legally designated lands created to conserve biodiversity and ecosystems. Conservation rules within these areas can restrict land use, protect habitats, and maintain ecological balance. Because of these restrictions, farms operating near protected areas may face regulatory constraints, monitoring pressure, and reputational risks. Importantly, these policies operate through spatial restrictions, which means that farms' biodiversity exposure depends on where their facilities are located relative to these protected areas. So our main measure of biodiversity exposure is based on farms' location, especially polluting facilities location. The United States provides a particular useful setting for us to study these effects. The US hosts one of the largest protected area networks in the world, covering more than 1 million square kilometers, which is roughly 13% of the country's land use. This conservation tradition traces back to Yellowstone National Park, established in 1972 as the world's first national park, which set a precedent for modern conservation globally. The governance of these areas is multi-layered, involving federal, state, local, private, and indigenous authorities, so multi-layers of governance. Importantly, regulatory influence often extends beyond the formal boundaries of the protected areas. For example, environmental regulations such as the Clean Air Act's provision of significance deterioration program impose stricter pollution controls near protected lands. Similarly, critical habitats designated under the Endangered Species Act can constrain development even outside protected boundaries. These spillovers can increase compliance costs and operational constraints for firms located near protected areas. As of September 2022, the US contained over 40,000 protected areas. Since 1990, more than 13,000 new sites have been designated, reflecting an expanding and heterogeneous conservation landscape. We also utilize these increasing protected areas, the protection to conduct the DID analysis in our additional analysis as well. The IUCN classifies as protected areas into 6 categories, ranging from strict nature reserves to multi-use conservation areas. Strict nature reserves prohibit nearly all human activity, and national parks, which are under Category 2, permit limited recreation, and categories 3 and 4 emphasize species or habitat-specific protection, and categories 5 and 6 allow sustainable resource use, which means limited economic activities are permitted. We have this figure shows the geography of US protected areas based on IUCN classification. Stricter categories are shaded in dark green and multi-use zones in lighter green. And so we can see the protected areas actually cover almost the whole US. And also at the same time, protected areas vary significantly in their conservation objectives and regulatory stringency. This variation means that firms' biodiversity exposure depends not only on geographic proximity, but also on the ecological and regulatory salience of nearby areas. For investors, this adds an additional layer of complexity when assessing the potential economic implications of biodiversity exposure. In our study, we position that biodiversity exposure may create information frictions for investors. Our framework builds on the literature on information frictions, which shows that uncertainty and noise reduce the clarity of disclosures and raise investors' information processing cost. Our argument is that firms operating near protected areas may face regulatory uncertainty, land use restrictions, or reputational risks. These factors make it harder for investors to assess how current earnings translate into future cash flows. In addition, biodiversity risks are inherently spatial and heterogeneous. For example, two firms with similar emissions may face very different biodiversity risks due to locations of their operations. Investors must therefore combine geographic exposure, ecological sensitivity, and regulatory constraints to evaluate these risks. From an information processing perspective,
Hi, Tracy. I don't know whether we have some issues with your internet connection.
Research
Yeah?
shows that.
Sorry,
sorry?
Tracy. There are some issues with your internet connection. So if you can repeat the last argument, please. Thank you.
All right, okay. Sorry, I didn't realize. So the internet connection is not stable. Yeah, so our study, our theory is built on the literature on information frictions, which shows that uncertainty and noise can reduce the clarity of disclosures and raise investors' information processing cost. Because firms operating near protected areas may face regulatory uncertainty, land use restrictions, or reputational risks. These factors make it harder for investors to assess how current earnings translate into future cash flows. In addition, because biodiversity risks are inherently spatial and heterogeneous, two firms with very similar emissions may face very different biodiversity risks due to the locations of their operations. Therefore, investors must combine geographic exposure, ecological sensitivity, and regulatory constraints to evaluate these risks. Therefore, our argument is that from an information processing perspective, investors may become less responsive to earnings announcements when they face higher information processing costs. So this is our basic argument built on information processing cost theory. Therefore, we have our main hypothesis about the effect of corporate biodiversity exposure on market responsiveness to earnings announcements. We predict that the pricing of earnings news is lower for firms with greater biodiversity exposure. And also, we consider cross-sectional variations. One factor we consider is institutional environment. We argue that firms with greater ecological fragility, regulatory enforcement, and shareholder scrutiny can face increased uncertainty around biodiversity-related risks. Therefore, the impact of biodiversity exposure on the pricing of earnings news is greater for firms with those institutional environments. Another factor we consider is firms' information environment. We argue that firms' transparency and external monitoring can help investors interpret biodiversity-related risks. Therefore, the negative effect of biodiversity exposure on the pricing of earnings news is mitigated by information transparency and external monitoring. So these are our two cross-sectional hypotheses. And then it comes to how we construct our sample and data. Our objective is to capture biodiversity exposure that generates valuation relevant regulatory and compliance risk arising from ecological externalities rather than mere geographic proximity to protected land. So we focus on TRI reporting facilities because biodiversity-related financial risk is most likely to rise in settings where firm operations generate emissions, discharges, or other ecological externalities subject to environmental oversight. So this is our sample construction, the fundamental underlying assumption. In our additional analysis, we also include non-polluting facilities as a falsification test and didn't find the effect of firms' exposure to protected areas would affect market reaction to earnings announcements. So we start with our sample with polluting facilities. And we construct our sample using multiple data sources. And our sample consists of US-listed firms with facilities reporting to the EPA's toxic release inventory, as I mentioned earlier, covering the period from 1990 to 2021. So it's a very long period covering over 30 years. And our sample contains over 2,000 unique firms and over 3,300 unique facilities. So this is a very large sample. We combine data from various sources. First, we obtain geospatial data on protected areas from the World Database on Protected Areas. Second, we use facility level information from the NETS database combined with pollution data from the EPA. Finally, we obtain firm level financial data from CompuStat, stock returns from CRISP, and analyst forecast data from ABAS. These are standard data sources. This combination of data sets allows us to link firms' operations to nearby protected areas and measure biodiversity exposure at the firm level. We construct our main variable corporate biodiversity exposure, or CBE, using facility level geographic information. First, we identify firms' operational facilities that report to the EPA's toxic release inventory. And then we map these facilities to nearby protected areas using geospatial boundaries from the World Database on Protected Areas. For each facility, we calculate the amount of protected area located within a 30-kilometer radius, which reflects the local ecological and regulatory environment. We then aggregate this exposure across all facilities belonging to a firm to construct a firm-level biodiversity exposure measure. Because our earnings announcements events at the firm level, therefore, we need to construct the biodiversity exposure to a firm level measure, but we need to look at the facility level data. So we aggregate the facility level data to firm level measure. We scale the CBE by the nationwide conservation footprint to capture the ecological density of protected areas in the firm's operating environment, thereby isolating variation arising from geographic placement rather than firms' scale or the number of facilities. So this is our measurement because our theory focuses on the environmental environment of firms' operations within the external environmental environment. So we want to capture the external environmental environment, not the firm's scale or the level of the number of facilities. To measure how investors respond to earnings announcements, we use a standard approach. We look at the earnings response coefficient, or ERC. Our return measure is the abnormal stock return over the 2-day window around the earnings announcement. And our earnings surprise measure is standardized unexpected earnings constructed using analyst forecast from ABAS. These measures are standard measures. The key test examines whether the interaction between biodiversity exposure and earnings surprises is negative. This is our main model. Our analysis is at the firm quarter earnings announcement level. And in our model, we interact our biodiversity exposure measure, CBE, with earnings surprise. So this is our test variable. And also we include a set of controls, controlling for firm's fundamentals, information environment, and also earnings announcement characteristics. At the same time, we also control for firm fixed effects and also year quarter fixed effects. We also interact all the controls and fixed effects with earnings surprise. And this is our summary statistics. So basically, if we look at the statistics, because in our sample, we restrict the sample to all firms that have some level of biodiversity exposure, at least at some point in time during our sample period. Therefore, all firms, they have a certain level of exposure because one typical criticism is that biodiversity exposure might be rare, or it might be a rare event, but it's not the case in our sample because all our sample firms have certain levels of biodiversity exposure. And also the summary statistics of abnormal returns and other firm level characteristics and earnings announcement attributes similar to those statistics reported in the literature. And this is the table of our main test for hypothesis 1. In column 1, we don't include any controls. And then in the following columns, we gradually add the controls and fixed effects. In column 2, we add controls. In column 3, we add controls, but not interaction with earnings surprise. And in column 4, we add interactions between controls and the earnings surprise. And then in the last column is the full model we used in our analysis, which includes all the test variables and the controls and their interactions with the earnings surprise. So we can see that across the models, the test variable, the interaction between CBE and earnings surprise, the coefficient is relatively, similar, remains quite similar around 0.007. And in the full model, even after we include the full set of controls and their interactions with earnings surprise, and the magnitude of the coefficient still remains very similar. So economically, the economic significance of our result can be interpreted as this: 1 percentage point higher CBE would reduces the return differential between the top and the bottom earnings surprise decimals by approximately 4.5%. So this is the interpretation of the economic significance. And then we also construct alternative CBE measures to examine whether our results hold. In column 1, we use a weighted measure. Remember in figure 1, we look at the different levels of protected areas because some protected areas are subject to stricter protection, and therefore we assign a higher weight for those protected areas. So this is a weighted CBE biodiversity exposure based on the strictness of the protected areas. And we find that the interaction between CBE and the protected area is significantly negative, which means for protected areas that are subject to greater level of protection, the negative effect of CBE on earnings responsiveness is greater. And then in column 2, we look at government protected areas. In column 3, we look at non-government protected areas because, as we discussed, protected areas are subject to different levels of protection. Some are protected by government agencies, others are by private sectors or indigenous communities. We can find that the effect actually remains for both government protected areas and non-government protected areas. And then we look at alternative measurement of market responses to the biodiversity exposure. The first column, we look at abnormal trading volume. And then in the second column, we look at bid-ask spread. So we can find that higher CBE is associated with lower abnormal trading volume and higher abnormal spreads around earnings announcements. This indicates weaker trading responses and reduced liquidity. And then here we use dynamic DID. The first column is a DID, the second column is a dynamic DID. So as we mentioned, during our sample period since 1990, there have been over 13,000 newly designated protected areas. So this allows us to conduct a DID analysis to look at the effect of firms who newly exposed to protected areas on their earnings response, the investors' earnings responsiveness to earnings announcements. So this is a stacked DID for each exposure event. We construct a cohort and then stack all the cohorts to run DID analysis. The DID analysis is consistent with our main analysis. We find that firms experience reduced market responsiveness to earnings announcements after they are exposed to protected areas. And then in the second column, we look at dynamic DID. We replace the post indicator with a set of year indicators. And we find that the effect of biodiversity exposure only appear after firms in the exposure event. We use T equals to 0 to represent the event year, the new biodiversity exposure event year, and year T equals 1 to indicate the first year after the exposure. So we find that the effect only appear from the exposure year and also after. So yeah, so in year T, the first year after the exposure, but the effect disappear in the second year and the third year after the exposure. So our interpretation is that after several years of exposure, investors can better learn the implications of the biodiversity exposure. Therefore, it mitigates the negative effect of CBE on investors' reaction to earnings announcements. And then here we conduct a number of falsification, placebo, and timing tests. In the first column, we look at non-polluting facilities. Because in our main analysis, we only focus on polluting facilities. Our argument is that the biodiversity exposure would have a fundamental impact for firms when they have polluting facilities near the protected areas. For firms whose facilities are non-polluting, and then the negative impact is not obvious, because imagine if you don't have any pollution, right? So it's unlikely that firms would attract regulatory enforcement and also community boycotts and so on. Consistent with our prediction, we find that firms who have only non-polluting facilities near the protected area, actually they don't experience reduced market reaction to earnings announcements. And then in the second column, we randomly assign earnings announcement dates. So those earnings announcement dates are false announcement dates. So this is just the placebo test. We find that the randomly assigned earnings announcement dates for those false earnings announcements, we don't have any observed effect of CBE on the abnormal returns around the false earnings announcement dates. So this is consistent with our argument about the information processing cost, because around the real earnings announcement dates, we have the earnings information released. And then in the third column, we look at the pre-earnings announcement, the abnormal market returns, to address the concern that market may have already reacted to biodiversity exposure before the earnings announcements. So we don't find pre-earnings announcement, the information, the reaction. And then in the fourth column, we look at post-earnings announcement drift, because one concern is that our observed negative relation between corporate biodiversity exposure and the market reaction to earnings announcements may reflect a delayed reaction. So it's likely that after firms release the earnings announcements, the market gradually incorporates the information to earnings announcements. However, in column 4, we can see that we exclude the alternative explanation of earnings announcement, post-earnings announcement drift. And then it comes to our cross-sectional analysis. We look at the institutional environment. So this is related to our hypothesis 2. Firstly, we look at the state level species protection, and second column, we look at the state level biodiversity protection rating. So we find that for states with lower levels of species protection and biodiversity protection rating, and then the negative effect of biodiversity exposure on market responsiveness to earnings announcements is more severe. And also we look at the counties that don't meet the the air pollution, the quality of air pollution, the investigation, and those counties are classified as non-attainment areas. And then for those areas, actually, they are subject to greater regulatory enforcement. And therefore, consistent with our expectation, we find that the negative effect of CBE on earnings response coefficient is more pronounced. And then in the fourth column, we look at biodiversity related media coverage. So actually, we conduct content analysis of business presses of the local counties. We look at whether the biodiversity, the media coverage can mitigate the information friction. Actually, consistent with our prediction, we find that for counties with lower level of biodiversity media business press coverage, and then the negative effect of CBE on ERC is more severe. And then finally, we look at the population density at the county. The argument is that for counties with lower levels of population density, and then those firms are subject to lower levels of community scrutiny, and then the negative effect of CBE would be greater, and then we find consistent results. So this is a table about our hypothesis 2 about the institutional environment. And then we look at firm-level information environment. These measures are constructed at the firm level. Firstly, we look at firms' biodiversity disclosure, and then we look at firms' institutional ownership. In column 3, we look at analyst coverage. And in column 4, we look at media coverage. This is firm-level media coverage, different from the institutional environment where we look at county-level biodiversity media press coverage. And then lastly, we look at firms' NGO scrutiny, whether firms are followed by NGOs for sustainability issues. Across all the measures, we find consistent results that when firms have more transparent information environment, the negative effect of CBE on ERC is mitigated. And then we conduct a number of additional robustness tests. Firstly, we control for plants, the number of firms' facilities to control for the effect of firms' operational footprint. So this is the firm level measure because some people may argue that for firms with a greater level of the operational footprint, right? For example, captured by the number of facilities, they may have greater biodiversity exposure. Therefore, our results may reflect simply from scale, but we can exclude that explanation by controlling for the number of total plants. And also we control for ESG score to exclude the alternative explanation that our results may simply reflect a general sustainability issue. And we also control for earnings quality to exclude the explanation that our results may reflect poor reporting quality of firms with greater levels of biodiversity exposure. And also in columns 4, from column 4 to column 7, we include controls for the climate policy and the climate exposure and natural disasters to disentangle the potential confounding effect of climate factors. And notice that for all the specifications, in addition to controlling for these additional controls, we also interact those controls with the earnings surprise. That's about all the evidence we present in the study. So in summary, we find that proximity to biodiversity sensitive areas weaken market reactions to earnings announcements. And our study provides new evidence on how biodiversity exposure affects capital market outcomes. And the implications of our studies is that for firms, excuse me, for firms and investors, clear, spatially anchored biodiversity exposures are important for effective risk assessment and evaluation. For policymakers, preserving market efficiency and ecological pressure requires spatially explicit biodiversity reporting because in our analysis, we find that information transparency actually plays a very important role in mitigating the negative effect of biodiversity exposure on firms' earnings response coefficient. And then biodiversity exposure is a material financial risk. We know that it reduces the gap between ecological complexity and investor interpretability. And therefore, in our study, we actually review some new insight about the interaction between non-financial factor and financial factor. So the non-financial factor of biodiversity exposure can affect market interpretation of earnings surprises, earnings information. Before I finish, Cassie kindly suggests we briefly explore possible collaboration between our AFANS ESG Special Interest Group and BAFA Corporate Governance Special Interest Group. So I have thought about this and think there would be many nice opportunities for us to collaborate. For example, we can host joint seminars and workshops or initiatives supporting our early career researchers. These are just some initial ideas, and we would very much welcome any suggestions from colleagues. And thank you very much. Any comments are welcome.
Tracy, that's fantastic. Thank you so much for the presentation. Great study, great insights, and clearly a lot of work has been put into the empirical work because you can see the thoroughness and both of the methods, but also of all the different angles that you have tried to tackle. So I would invite everybody that has questions for Tracy to please raise your virtual hand. We have about 10 minutes for Q&A. So Tracy, if you don't mind, let me kick off with the questions. So I found the story very convincing, right? So I can definitely, see where you're coming from. But one of the things that I don't understand is what is unique about biodiversity exposure risk? Because you can expect any kind of risk, any kind of uncertainty to have this impact to earnings response coefficients. So what is unique about this biodiversity exposure risk that leads to these insights? And if anything, would you expect it to be more material, more important compared to other types of risk? Thank you.
Mm-hmm. Yeah. So biodiversity risk, because in our study, actually, we look at the spatial exposure, right, based on firm's facility level exposure. This is location-based, different from many other environmental risks such as emissions. Because the biodiversity exposure is location-based, it's a spatial risk. And also the level of exposure just not only depends on the proximity of the areas to the protected areas, but also depends on the the level of enforcement, regulations and enforcement. So for biodiversity, the exposure risks actually currently, even though we have TNFD, the disclosure framework, actually, so the regulation, the framework is also currently is very broad, and the practitioners' response is that, currently, even though we have a lot of data, for example, the location level data or the protected areas are public information. But for investors to integrate those information to understand how the exposure would affect, firms' earnings, the current earnings, to map future earnings. So this is a very challenging. It's not like, for example, emission. The measurement is very easy, right? We can clearly measure, how large is your emission, and then there are clear standards. Nowadays, framework actually have a very clear framework, and many countries have also imposed standards, including Australia and some European countries as well. So our argument is not about the availability of the data, but it's about how to interpret, the impact of the biodiversity exposure and the implications for firms' earnings.
Right. Okay. Thank you for that. So, Da, if you want to chip in, yes. Thank you.
Thank you. Thanks, Tracy, for the presentation. Really nice paper. So good luck with that. Just one clarification and one question, please. When you're measuring the earnings announcement, sorry, I missed it. So do you take into account whether the earning is expected or unexpected?
Oh, so when we look at earnings surprise, it's unexpected earnings. Yeah. So we compare the actual earnings with the expected earnings.
That's good.
The forecast.
And I suppose you treat like, the lower unexpected and above the expectation unexpected in the same way. Like, if the unexpected earning is lower, or so do you take the absolute value, or do you consider the sign as well?
Yeah, it's absolute value, and it's that's ranked. Let me see the model, the measure earnings surprise. Whoops. Earnings surprise. Yeah, so it's that's ranked. Yeah.
Ranked, right? Okay. Because I thought, like, maybe it's worth checking, like, the reaction to the positive and the negative separately.
Yeah, it's a great suggestion. So actually, we tested that. We look at positive news and negative news, because here it's an absolute value, that's ranked. We look at the amount of surprise, but whether the effect remains the same across good or versus bad news. This is a very good suggestion. We have done that. Actually, we didn't find a significant difference across the different levels, of news. Our argument is that, if it's the information processing cost channel, and then the effect should be we should be able to observe the same effect, right? But if it's a risk story, downside risk story, we should observe a greater negative effect for negative growth.
Exactly. Yeah. So that would be worth checking. And my question was in relation to, do you know about the nature of these protections, the biodiversity protections? Is it possible to know what sort of protection is it? Is it protecting just the land where there is a historical building, or is it protection related to a particular species, for example, an endangered animal or plant and things like that? Again, the implication in that is that not all of these protections will be perceived in the same way for all of the firms. So if a firm's activity is not related to that protection, if the protection is for protecting an animal, where the activity of the firm is not related to in any way to that animal, then investors might just ignore it. But if a firm is, let's say, producing pesticides, for example, and the protection is in relation to a particular species, then investors would see that reaction more. But I'm not really sure, whether that's possible or not. So that will give you a more direct chain, and then, why people react to it in this way.
Yeah, thank you. Yeah,
Thank you.
that's a very good suggestion. So if we look at the IUCN classification of protected areas, actually it's very interesting. So for areas, protecting wilderness area, right? The wild animals and so on. Actually, they are subject to stricter protection. And then for the species and habitat specific protection, and so they actually they are the multi-use sustainable area protection, and then limited economic activities are permitted. So we can see, we also use the weighted measure. We assign a higher weight for areas that are subject to stricter protection. So the challenge of testing, the types of area, whether it protects, for example, animals or species, or those protection in different types of protections are also related to the strictness of the areas. So yeah, it's a kind of so if we are seeing, we assign a weight for areas that are subject to stricter protection. Actually, those are areas that protect wilderness areas. Yeah.
Thank you. Thanks.
Great.
It's
So,
a great suggestion.
Are there any other questions? If there are questions, please raise your virtual hands.
Sorry.
Yes.
Yeah, I received 2 questions when we promote the event. One question is I think it could be like the suggestion more than a question. Which risk is more close monitored by the markets? Do you think it's the climate change risk or biodiversity risk here?
Biodiversity. Sorry, can you say climate change?
Yeah, climate change risk or biodiversity risks. So
our setting is different from climate risk because, like I explained, the biodiversity risk is different from other environmental risks such as climate risk because it's location based, it's spatial. And then it's very complex. My co-author Lydian just presented the paper at NUS, and then they had practitioners, participated in the conference. And the feedback is that for practitioners, actually, the complexity of biodiversity protected areas, and it's different from the the climate risk, the general sustainability issues. But for our academics, probably it's just an emerging research, and then it it's our obligation to explain clearly, because it's an emerging research area, the differences between biodiversity protected areas and the climate risk. Because like in this map, for example, for the same for two firms, right, which, for example, which have the same level of emission, but if their facilities are located in different protected areas, or even though they are located in close to protected areas, but the levels of protection differ, and then the implications for their biodiversity exposure is quite different. So this is the complexity of biodiversity exposure. It just goes beyond the emissions or traditional climate risk. Yeah.
So we have limited time, a couple of minutes left, but we have two questions. So Stephen, if you would like to go first, please.
Thanks. Tracy, we know when we look at earnings response coefficients that they differ between negative surprises and positive surprises. And that difference is because we know that negative surprises are less persistent than positive surprises are. So when you show me a result that says that that the earnings response coefficient is impacted by biodiversity exposure, the first thing that would probably help me understand why that might be the case, why you see this attenuation, is whether or not earnings persistence or earnings surprise persistence actually differs between firms that have high biodiversity exposure and firms that have low biodiversity exposure. That, to me, is a critical piece of evidence, and I don't know if you have that, but I don't think you referred to it. But, that's sort of the very first step, I think, in understanding what's actually happening.
Yeah, thank you very much, Stephen. This is a brilliant point. Actually, I didn't mention we did the test. We examined whether firms with greater biodiversity exposure, have less persistent earnings. So actually, we didn't find significant differences. So this is not about the disclosure quality. We also look at the discretion across, and in addition to earnings persistence. Yeah. Thank you. Yeah, this is a great point. We need to add the. We need to add that. Yeah, definitely, because we plan to add the analysis to the paper. Yeah, definitely this is very important. Thank you.
Thanks. I know we're short of time.
Thank you so much. Last question, please. Please go ahead.
Hello?
Yeah. Please go ahead.
Yes, please. Thank you. May I ask then, is there any data to show that there's effects on the environmental protection on the financial and environmental performance of the U.S. firm, instead of just looking at the correlation and results?
The environmental effect of environmental protection?
Yes, I mean, for example, like you show that there's a protected area from your data, and is there any example to show that such kind of protection will affecting the U.S. firm, their earning or environmental performance?
If protection affects earnings. So we didn't look at the effect of the protection biodiversity protection on firms' earnings,
Right.
But it's likely the protection can affect earnings. However, we controlled for the fundamentals. I think we got a comment about the effect of CBE on firms' fundamentals. I think is similar to your question, right? So in our analysis, we controlled for firms' fundamentals and also interact the firms' fundamentals with the earnings surprises. So even though CBE may affect the firms' fundamentals or earnings, but we controlled for that effect. So the effect we observe is an incremental effect, not the impact of CBE on firms' earnings per se.
Right.
Yeah, we also controlled for the environmental, factors, climate factors, or firms' overall ESG scores, earnings quality, and so on. Yeah, so we just wanted to disentangle, the information processing cost, this argument from other arguments like fundamentals or risk or growth and so on.
Okay, thank you. Thank you.
Right.
Thank you.
Okay. So, unfortunately, Tracy, we have run out of time. It's been great. Very interesting to me, even though I don't necessarily work in this particular area, but I've learned a lot today. So thank you so much for a very insightful presentation and Q&A. And I'm definitely going to take away, this proposal to the executive committee of the BAFA corporate governance SIG, and we're going to be in touch. Thank you again for presenting today, and we look forward to future collaborations. Thank you so much. And thanks everybody for joining.
Thank you very much.
See you at the next event. Thank you, Tracy.
Thank you. Thank you. See you.